Let me begin with a simple question, one that economics students are rarely encouraged to ask. What happens when a financial system sells promises it may not be able to keep? Because that question sits at the very heart of today's silver market, and it tells us far more about capitalism than it does about any single metal. Now, consider this. Reports indicate that JP Morgan sold roughly 40,000 silver call options approaching December 20th. Expiration options, of course, are promises. Promises to deliver silver at a certain price, but the real issue is not the number. The issue is whether the system that sold those promises can actually fulfill them. In modern commodity markets, silver increasingly exists in two parallel forms that rarely intersect in a meaningful way. The physical metal that must be mined, refined, transported, and stored, and the vast universe of financial claims that represent ownership in name only. Over the past several decades, the growth of derivatives tied to silver has far outpaced the growth of the actual metal available for delivery. This divergence is not a minor technical detail. It is a structural feature of contemporary capitalism, and it deserves serious economic scrutiny. What makes this imbalance especially striking is how normalized it has become. Every day, enormous volumes of silver are bought and sold without a single ounce changing hands. Futures contracts, options, swaps, and exchange-traded products circulate at speeds no physical commodity could ever match. These instruments are often justified as tools for liquidity and price discovery. Yet, when the quantity of paper claims multiples many times over the underlying physical supply, liquidity begins to resemble illusion rather than stability. At that point, the market is no longer anchored to material reality but to confidence in the system of promises. Consider how this affects perception. To the outside observer, silver may appear plentiful because its price remains relatively contained, but price, in this context, is shaped by a flood of paper supply that has little connection to mining output or industrial demand. This creates a misleading signal. Industries dependent on silver, from electronics to renewable energy, may underestimate long-term supply constraints, while investors may misjudge risk by trusting a price formed in a distorted arena. There is also a deeper systemic consequence. When the volume of financial claims dwarfs the physical asset, the market stability depends not on silver itself but on continued faith in counterparties, clearinghouses, and institutional discipline. Confidence replaces collateral as long as participants believe others will accept cash, settlement, or roll contracts forward. The system functions, but confidence is not a physical resource. It can evaporate quickly under stress. Moments of stress are precisely when these imbalances matter most. Sudden demand for delivery, supply disruptions, or geopolitical shocks can force the question that paper markets prefer to avoid. Is there enough silver to honor these claims? History suggests that when the answer is no, the market does not admit failure. It changes the rules. Delivery requirements are relaxed. Settlements are converted to cash, and the abstraction is preserved at the expense of transparency. This dynamic reveals a broader truth about how modern markets prioritize efficiency over resilience. Paper silver allows institutions to manage risk on balance sheets, but it transfers uncertainty into the system itself. The more paper claims accumulate, the more the market relies on mechanisms that prevent physical reckoning. What appears efficient in calm conditions becomes brittle under pressure. The real hook, the one that challenges comfortable assumptions, is this. A market can function smoothly for years while becoming increasingly disconnected from the very commodity it claims to represent. Silver, in this structure, is less a traded good and more a symbolic anchor for financial activity. The imbalance between paper and physical supply is not an anomaly waiting to be corrected. It is the foundation upon which the current system operates, and understanding that foundation is essential for anyone trying to make sense of price behavior, market risk, and the deeper contradictions embedded in today's global economy. In theory, prices in commodity markets are meant to emerge from the interaction of real buyers and sellers responding to genuine supply and demand. In practice, particularly in the silver market, prices are increasingly shaped by financial instruments that allow influence without ownership. Derivatives make it possible to move markets not by acquiring or releasing physical silver, but by strategically positioning paper claims. This distinction is not semantic. It is fundamental to understanding how price formation has evolved under financial capitalism. Derivatives were originally justified as risk management tools. Producers could hedge future output, and consumers could stabilize costs. Over time, however, their function expanded far beyond hedging. That large institutions discovered that derivatives offered something far more powerful: leverage over price without the burden of physical constraints. One can sell or buy enormous notional quantities of silver with limited capital, and more importantly, and without ever engaging with the metal itself. The market begins to respond to financial pressure rather than material reality. This is where influence replaces participation. An institution does not need to hold silver to shape its price. It needs only to dominate the flow of contracts that reference silver. When large volumes of futures or options are introduced into the market, they create the appearance of supply or demand. Regardless of what is happening in mines, refineries, or warehouses, prices adjust to this paper flow because the trading infrastructure treats these contracts as equivalent to physical transactions. Even though their economic substance is entirely different, the hook lies in recognizing how quietly this shift occurs. There is no announcement that price discovery has been outsourced to financial strategy. It happens gradually through normalization. Traders, algorithms, and analysts begin responding more to positioning data, options, chains, and speculative sentiment than to inventory reports or production costs. The signal that once came from physical scarcity is diluted by a flood of financial noise, and the market adapts to that distortion as if it were natural. This environment favors scale. The larger the institution, the greater its ability to absorb short-term losses, post margin, and influence expectations. Smaller participants, including miners and industrial users, must respond to prices they did not meaningfully help create. When a dominant player sells large quantities of call options or futures contracts, it can effectively cap upside movement, not because silver is abundant, but because financial resistance has been engineered. Price becomes a managed outcome rather than an emergent one. What makes this especially significant is that derivatives influence not just prices, but behavior. If the market consistently signals that silver prices will remain contained, investment in new mining capacity may be delayed or cancelled. Exploration becomes harder to justify. Over time, physical supply tightens even as paper markets continue to project abundance. This is a classic example of how financial signals, detached from reality, can reshape that reality in destabilizing ways. Another rarely discussed aspect is how derivatives compress time. The physical markets operate slowly, mines take years to develop, and supply adjustments are gradual. Derivatives, by contrast, react in milliseconds. This temporal mismatch allows short-term financial strategies to overwhelm long-term fundamentals. A sudden surge in paper selling can override months of tightening physical conditions, creating price movements that seem irrational when viewed from the perspective of real production and consumption. The deeper issue is not manipulation in the sensational sense, but structural dominance. The rules of the market permit, and even reward behavior, that prioritizes financial efficiency over truthful pricing. As long as derivatives are treated as substitutes for physical transactions, those who control derivatives will control prices. This is not a flaw at the margins. It is the logical outcome of a system that elevates financial instruments above the commodities they reference. The most unsettling hook is this: a market can appear liquid, orderly, and rational, while systematically mispricing the very good it exists to trade. Derivatives do not merely reflect the silver market, they increasingly define it, and when price discovery is driven by financial leverage rather than physical exchange, the resulting prices tell us less about silver and more about who holds power within the financial system. In financial markets, risk rarely disappears. It is relocated. When large volumes of call options are sold without sufficient physical backing, the immediate appearance is one of efficiency and liquidity, but the underlying reality is a redistribution of risk away from the seller and into the system itself. This is not a moral claim, it is a structural observation rooted in how derivatives function within modern capitalism. A call option is, at its core, a promise. It grants the buyer the right to acquire silver at a predetermined price, while obligating the seller to deliver or settle if that right is exercised. When such options are fully backed by physical inventory, the risk is contained and transparent. But when they are not, the obligation becomes conditional, dependent on market behavior, institutional flexibility, and the willingness of the system to absorb stress. The hook here is simple and unsettling. The promise remains firm. Even when the metal does not, in practice, unbacked call options are often justified by probability. Sellers assume that most options will expire worthless or be settled in cash. Individually, this assumption may appear reasonable. Systemically, it becomes dangerous. When many institutions rely on the same assumption, the market transforms into a collective wager that physical delivery will never be seriously demanded. Stability then rests not on supply, but on coordinated expectation. This is where risk quietly migrates. The seller collects premiums and reports profits, while the exposure shifts to clearinghouses, counterparties, and ultimately the market infrastructure itself. And if prices rise sharply or delivery demand increases, the obligation does not vanish, it expands outward. Margin requirements tighten, liquidity strains emerge, and stress concentrates in places designed to absorb shocks, rather than generate profits. What looks like prudent risk management at the firm level becomes fragility at the system level. The professional illusion is that diversification solves this problem, yet diversification fails when risk is correlated, and unbacked options create precisely that condition. If many sellers are exposed to rising prices simultaneously, their responses reinforce one another. They buy contracts to hedge, driving prices higher, increasing losses, and amplifying volatility. The hook lies in recognizing that the very tools meant to manage risk can accelerate it when used at scale. Another layer of concern arises from the role of cash settlement. Markets often rely on the assumption that obligations can be satisfied financially rather than physically. This works until it doesn't. Cash settlement avoids immediate delivery stress, but it introduces a different problem. It severs the link between the contract and the commodity. When that link weakens, prices no longer discipline behavior. Sellers can continue writing options without confronting physical constraints, and risk accumulates invisibly. This dynamic also reshapes incentives. If institutions know that extreme outcomes will trigger rule changes, emergency liquidity, or regulatory forbearance, their tolerance for exposure increases. This is not recklessness, it is rational behavior within a system that repeatedly demonstrates its willingness to protect. Continuity over accountability. The hook here is uncomfortable. Systemic risk is not an accident, it is a byproduct of predictable responses. From a broader economic perspective, unbacked call options represent a familiar capitalist contradiction. Profits are realized immediately through premiums, while potential losses are deferred and distributed. The time gap between gain and consequence creates an asymmetry that favors scale and sophistication. Smaller participants cannot play this game. They face prices shaped by risks they did not create and consequences they cannot hedge. Stress events reveal the cost of this structure. When volatility spikes or delivery expectations shift, the market scrambles to contain damage, clearinghouses raise margins, liquidity dries up, and intervention becomes necessary to prevent cascading failure. These moments are often described as anomalies, yet they follow directly from the routine practice of allowing promises to exceed capacity. The most compelling hook is this. A system can appear stable precisely because its risks are hidden. Unbacked call options do not announce themselves as threats. They blend seamlessly into normal trading activity. But stability built on deferred obligations is conditional stability. It depends on prices behaving, demand remaining passive, and confidence staying intact. When any of those conditions change, the risk that was quietly outsourced returns larger and more concentrated than before. In financial markets, most days are routine, almost uneventful. But expiration dates are different. There are moments when assumptions are tested and abstractions are forced to confront reality. Options expiration, in particular, acts as a pressure point where the promises embedded in derivatives must either be honored, transformed, or deferred. This is why expiration dates function less like calendar events and more like stress tests for the entire market structure. Under normal conditions, options trade as probabilities. Traders model outcomes, hedge exposures, and assume that most contracts will never require decisive action as long as time remains. Uncertainty provides flexibility, but when expiration arrives, uncertainty collapses into binary outcomes. The option either expires worthless or it becomes an obligation. This transition exposes whether the market's confidence was grounded in physical capacity or merely in expectation. The hook is simple but powerful. Expiration removes excuses. In the silver market, this stress is amplified by the imbalance between paper claims and physical supply. Leading up to expiration, positions can be rolled forward, closed out, or offset. These maneuvers create the impression of control, yet each of them relies on liquidity and cooperation. At expiration, that cooperation is no longer optional. The market must reconcile outstanding claims with what can actually be delivered or settled. This is where theoretical pricing models encounter logistical limits. What makes expiration dates especially revealing is how quickly stability can depend on intervention. If too many option holders choose to exercise, the system faces immediate strain. Physical delivery requires inventory, transportation, and timing. Cash settlement requires liquidity and agreement on price. When neither path is frictionless, the market's resilience is exposed. The hook here is uncomfortable. Smooth functioning often depends on participants not asking for what they are contractually entitled to. This dynamic changes behavior well before expiration arrives. Institutions monitor these dates closely because they represent moments when control weakens. Volatility often increases, not because fundamentals suddenly change, but because risk becomes visible. Positions that looked safe under probabilistic assumptions must now be resolved. The market begins to react not to supply and demand, but to the fear of forced outcomes. Expiration also reveals the hierarchy within markets. Large institutions possess flexibility. They can roll positions, negotiate settlements, or absorb losses. Smaller participants they face prices shaped by last-minute adjustments and liquidity squeezes. The stress test is therefore unevenly distributed. The system protects continuity, but not equality. This is not accidental. It reflects whose stability matters most to market functioning. Another critical aspect is how expiration exposes the reliance on rule flexibility. When delivery pressure mounts, markets often respond by adjusting requirements, encouraging cash settlement, or expanding margin calls. These measures preserve order, but they also confirm a deeper truth. The system prioritizes survival over strict fulfillment of contractual intent. The hook lies in recognizing that contracts are only as firm as the system's tolerance for disruption. From an economic standpoint, expiration dates challenge the idea that markets are self-correcting. If prices truly reflected physical constraints, expiration would be uneventful. Delivery would occur smoothly, and obligations would be met routinely. The very fact that expiration generates anxiety indicates a disconnect between price signals and material capacity. Stress does not arise from scarcity alone, but from the mismatch between promises and resources. These moments also shape expectations going forward. When markets successfully navigate expiration through cash settlement or intervention, confidence is temporarily restored, yet the underlying imbalance remains. Participants learn that the system will adapt to avoid breakdown, and this knowledge encourages further risk-taking. The stress test is passed, but at the cost of reinforcing the behaviors that made it necessary. The most compelling hook is this: expiration dates do not create instability, they reveal it. They strip away the comfort of rolling contracts and force the market to show how it resolves obligations when time runs out. Each expiration is a quiet examination of whether financial markets are anchored in reality or sustained by trust that reckoning can always be postponed. Markets are often described as neutral mechanisms where prices emerge organically from countless independent decisions. Yet, this description becomes increasingly difficult to sustain when power concentrates in a small number of institutions. In commodity markets such as silver, dominance by large financial players reshapes price discovery itself. Prices still move, trades still occur, but the forces behind those movements are no longer evenly distributed. The hook here is subtle but profound. When power concentrates, markets may continue to function while quietly losing their purpose. Price discovery is meant to signal information. It tells producers whether to invest, consumers whether to conserve, and investors how to allocate capital. And for this system to work, prices must reflect real conditions. But when a handful of institutions command vast balance sheets, advanced trading infrastructure, and privileged access to liquidity, their actions carry disproportionate weight. A single large position can outweigh the combined influence of countless smaller participants. The price becomes less a summary of collective judgment and more a reflection of strategic dominance. This distortion does not require explicit coordination or intent. It arises naturally from scale. Large institutions can enter and exit positions in volumes that alter market expectations. They can withstand temporary losses that would bankrupt smaller players, allowing them to maintain positions long enough to influence outcomes. The hook is that power does not need to announce itself to be effective. It simply needs the capacity to endure. In such an environment, supply and demand still exist, but they are filtered through financial leverage. A surge in physical demand for silver may be met not with higher prices, but with increased paper selling designed to absorb and neutralize that pressure. To observers, the market appears calm and orderly, yet beneath the surface, genuine signals are being overridden. The price tells a story, but it is not the story of silver itself. It is the story of who controls exposure. This has cascading effects. Miners make long-term decisions based on price expectations. If prices remain suppressed by financial activity, investment in exploration and production may decline. Over time, physical supply tightens not because demand disappeared, but because the price signal discouraged capacity. The distortion thus speeds back into the real economy, turning financial dominance into material consequence. Another hook emerges when considering information asymmetry. Large institutions operate with sophisticated analytics, access to order flow, and insights into positioning that others do not possess. They can anticipate reactions and shape them. Smaller participants, including industrial users and retail investors, respond to prices without seeing the forces behind them. The market appears transparent, but understanding is unevenly distributed. This asymmetry further entrenches dominance. Price discovery also becomes increasingly short-term. Dominant players focus on managing exposure, volatility, and quarterly results rather than long-term fundamentals. Short-term financial objectives overpower slower, moving realities such as mining costs, geological constraints, and industrial trends. The market's time horizon contracts, prices respond to positioning and sentiment rather than to enduring conditions. The hook here is that a market obsessed with immediacy loses sight of sustainability. This dynamic challenges a core assumption of classical economics that markets reward efficiency and punish distortion. In reality, markets often reward those who can shape the environment in which prices form. Efficiency becomes defined not by accuracy, but by profitability, as long as dominant players can extract value. The system treats outcomes as success, regardless of how misleading the signals may be. The result is a market that appears liquid and responsive, yet increasingly detached from the commodity it represents. Price movements convey confidence, but that confidence rests on concentration rather than consensus. The unsettling insight is that distorted price discovery does not cause markets to fail outright. Instead, it allows them to persist in a compromised state, delivering signals that are precise in appearance, but flawed in substance. Modern financial markets are often celebrated for their sophistication, yet beneath that sophistication lies a recurring pattern that defines how gains and losses are distributed. Large institutions design strategies that allow profits to be realized quickly and privately, while the risks those strategies generate are dispersed across the broader system. This asymmetry is not accidental. It is embedded in the structure of contemporary capitalism. The hook worth confronting is this: success in modern markets often depends less on being right than on ensuring that failure is never fully yours. In derivative-driven markets, profits are immediate and measurable. Premiums from selling options, spreads captured through high-volume trading, and fees generated from market making all flow directly to institutions. Balance sheets. These gains are booked, reported, and rewarded in real time. Risk, by contrast, is probabilistic and delayed. It exists in scenarios rather than in accounts. In stress events rather than in quarterly earnings, this temporal gap creates a powerful incentive to prioritize short-term profitability over long-term stability. When risks remain unrealized, they are invisible. Institutions appear prudent, well-capitalized, and disciplined, yet the exposure has not vanished. It has merely been transferred. Clearinghouses absorb counterparty risk. So liquidity providers stand ready to stabilize markets. Central banks prepare to intervene when volatility threatens systemic continuity. Each layer of protection reduces the immediate cost of aggressive strategies for those who deploy them. The hook here is unsettling. Protection intended to preserve stability also encourages risk-taking. Modern financial markets are often celebrated for their sophistication, yet beneath that sophistication lies a recurring pattern that defines how gains and losses are distributed. Large institutions design strategies that allow profits to be realized quickly and privately, while the risks those strategies generate are dispersed across the broader system. This asymmetry is not accidental. It is embedded in the structure of contemporary capitalism. The hook worth confronting is this: success in modern markets often depends less on being right than on ensuring that failure is never fully yours. In derivative-driven markets, profits are immediate and measurable. Premiums from selling options, spreads captured through high-volume trading, and fees generated from market making all flow directly to institutions. Balance sheets. These gains are booked, reported, and rewarded in real time. Risk, by contrast, is probabilistic and delayed. It exists in scenarios rather than in accounts, in stress events rather than in quarterly earnings. This temporal gap creates a powerful incentive to prioritize short-term profitability over long-term stability. When risks remain unrealized, they are invisible. Institutions appear prudent, well-capitalized, and disciplined. Yet the exposure has not vanished. It has merely been transferred. Clearinghouses absorb counterparty risk. Liquidity providers stand ready to stabilize markets. Central banks prepare to intervene when volatility threatens systemic continuity. Each layer of protection reduces the immediate cost of aggressive strategies for those who deploy them. The hook here is unsettling. Protection intended to preserve stability also encourages risk-taking. This dynamic reflects a familiar logic. If the upside is private and the downside is shared, rational actors will pursue strategies that maximize exposure over time. The system becomes saturated with latent risk. Everyone knows it exists, but no single participant bears responsibility for containing it. Accountability dissolves into complexity. When stress finally emerges, it is framed as a collective problem requiring collective solutions. Moments of crisis make this pattern visible. Volatility spikes, margins rise, and liquidity evaporates. Institutions that benefited most from a prior stability are suddenly dependent on the very system they leveraged. Interventions are justified as necessary to protect markets, pensions, and the broader economy. These justifications are often correct, but they obscure a deeper truth. The need for rescue arises from structures that consistently reward private gain while externalizing risk. The hook becomes sharper when considering who ultimately bears the cost. Smaller market participants face price swings they cannot hedge. Industries reliant on commodities encounter instability in input costs. Public institutions commit resources to preserve financial order. The burden is diffuse, spread across society, while the rewards remain concentrated. This is not a failure of individuals. It is the outcome of incentives aligned toward extraction rather than balance. What makes this arrangement durable is its subtlety. Risk socialization does not occur through explicit transfer, but through normalization. Market participants grow accustomed to the idea that extreme outcomes will be managed, that rules will adapt, and that continuity will be preserved, this expectation becomes part of pricing behavior itself. The market internalizes the belief that systemic protection exists, and this belief shapes decisions long before any intervention occurs. From an economic perspective, this undermines one of the central disciplines of markets: consequence. When losses are fully borne by those who incur them, behavior adjusts. When losses are dispersed, behavior persists. The system becomes efficient at generating profits and inefficient at signaling danger. Stability is maintained not by resilience, but by readiness to absorb shocks after they occur. The most provocative hook is this: markets that repeatedly survive crises may appear strong, but survival can mask deterioration. Each intervention preserves structure while reinforcing the incentives that made intervention necessary. So, over time, risk becomes a collective shadow, always present, rarely addressed directly. Profits continue to be celebrated as evidence of success, while the socialization of risk is treated as an unfortunate necessity rather than a structural feature. So when we hear that a major institution may have sold more silver than it can reasonably deliver, we should not ask, is this legal? We should ask, what kind of economic system rewards this behavior? Because until we confront that question honestly, we will keep mistaking symptoms for causes, and the crises will keep returning, expiration date after expiration date,